The most dangerous part of your next car repair isn't a bent frame or a cracked windshield. It's a contract. A contract you never signed, never read, and were never meant to see. And it was signed years ago between your insurance company and the body shop down the street, long before you ever slid across the ice and crumpled your fender. I want you to picture something. A mechanic in a clean shop. Skilled hands, 20 years of experience, a welding torch in his grip. He knows exactly how your car is supposed to go back together because the manufacturer wrote him a manual and he's read it. But look closer. There are thin strings running up from his wrists, up past the fluorescent lights, up through the ceiling, all the way to a glass office in a skyscraper downtown. And when it's time to fix your car, it isn't the mechanic who decides whether his hand reaches for the welding torch or the tube of glue. It's the person holding the strings. I call it the puppeteer's garage. And by the end of this video, you're going to be able to see the strings on any repair estimate you're ever handed. I know that sounds dramatic, so let me earn it. Let me tell you what this video is not, because that matters more than anything I'm about to say. This is not a video telling you insurance is a scam. It isn't. Auto insurance is one of the genuinely good ideas humans have come up with. Thousands of strangers each put a little money into a pool so that when one of them has a catastrophe, they don't lose everything. Your insurer pays out billions of dollars in claims every single year, and the overwhelming majority of those claims are handled fairly, quickly, and without anyone getting hurt. If your bumper gets tapped in a parking lot, the system usually works exactly like it should. I am not here to tell you to cancel your policy. I'm not here to tell you every body shop is cutting corners, because most of the people turning wrenches are honest and would fix your car right if you left them alone. And here's the part I want to be very honest about, because this is a math channel, not an outrage channel. The insurance company is not run by villains twirling their mustaches. It's run by people responding to incentives, rational, boring, spreadsheet incentives. That's the whole point. The problem isn't that bad people are doing bad things. The problem is that good people are following the math, and the math points somewhere ugly. So let me show you the math. At its core, an insurance claim is a tug of war over a single number. You pay a premium every month. In exchange, the insurer makes you a promise. If your car gets wrecked, we'll pay to put it back the way it was, back to factory specification. The manufacturer Honda, Toyota, Ford has a book that says exactly how your specific car must be repaired to be safe again, which parts, which welds, which sensors get recalibrated. That book is the promise you paid for. But every dollar the insurer actually spends keeping that promise is a dollar that leaves the pool. It's a dollar off their bottom line. So the insurer's incentive is not to fix your car the right way. The insurer's incentive is to fix your car the cheapest way that is still legal. Those are not the same thing. Read that again slowly. The cheapest legal repair and the correct repair are two different numbers, and the whole game is the gap between them. That gap is the one number I want you to carry out of here. Every dollar of gap between the repair you were promised and the repair they authorize is a dollar of profit for them and a sliver of risk transferred onto you. Not onto their balance sheet, onto your body and the bodies of the people who ride in your car. Keep that in your head. We're going to run that same number over and over with new inputs each time. Who keeps the dollar and who keeps the risk? Now, how does the puppeteer actually pull the strings? Through something with a friendly name, the Direct Repair Program, a DRP. Here's how it works, and it's genuinely clever. An insurer sits on a mountain of customers, millions of drivers who are going to crash and need repairs. That mountain is worth a fortune to any body shop because a shop lives and dies on a steady flow of cars through the bay. So the insurer goes to the shop and says, "We'll send you a river of guaranteed customers. We'll put you on the list we hand people after an accident. All you have to do is sign our little agreement." Think of it as renting the customer base. The shop doesn't own those customers. It rents access to them from the insurer. And rent always comes with terms. In that contract, the shop agrees to two things that will matter enormously to you when it's your car on the lift. First, the shop agrees to accept a capped labor rate, a number the insurer sets, not the market. Second, the shop agrees to run the insurer's estimating software, and that software gets to decide which parts go on your car. The mechanic still holds the wrench, but the strings decide where his hand goes. Let me show you exactly how, with real numbers. Start with the easy one, the bumper. Say you get rear-ended and your rear bumper cover is trashed. There's a bumper made by Honda for your Honda, built to the exact fit and crush specification. Honda engineered the part your safety systems were designed around. From the dealer, that OEM bumper runs somewhere around $800. There's also an aftermarket bumper, made by a third-party factory overseas, reverse-engineered, not certified by Honda, sometimes a slightly different thickness of plastic, sometimes mounting tabs that don't line up quite right. That one runs around $200. Now watch the software. The insurer's estimating system doesn't ask the mechanic which bumper is safer. It auto-populates the $200 aftermarket part. That's the default. That's the string. To put the correct $800 part on your car, the shop now has to stop, fight the system, call an adjuster, justify it, and often lose the argument. So run the one number. 800 minus 200 is $600. Who keeps that 600? The insurer does. And who keeps the risk that the cheaper bumper doesn't crush the way your car's sensors and crumple zones expect? You do. That's the gap. $600 of profit for them, an unknown amount of risk for you on one bumper. Now, here's where I have to be honest, because I promised I would be. Not every aftermarket part is dangerous. Some aftermarket parts are perfectly fine. A cosmetic trim piece, a non-structural panel, if it fits and it's decent, who cares? If the whole video hinged on aftermarket bad, OEM good, I'd be doing the exact thing this channel exists to fight, shouting a slogan instead of showing the math. So I won't. The problem isn't the existence of cheaper parts, the problem is who's choosing them and why. The choice is being made by a piece of software, optimizing for one thing, the gap, and not by the human who actually knows what's holding your roof up. Which brings us to the second string, and this one's quieter and meaner. Labor. A genuinely skilled auto body technician in a free market might bill around $100 an hour. That's not greed, that's a trained professional with expensive equipment and real liability. But the DRP contract says the shop will accept a capped rate. Call it $50 an hour, half. Sit with that for a second because the consequences are pure arithmetic and they are brutal. The shop's costs don't get cut in half. Rent doesn't. The technician's wages don't. The electric bill, the equipment, loans, the insurance on the building, none of that halves just because the insurer decided your labor is worth $50 an hour. So the shop is now trying to survive on half the revenue per hour with the same fixed costs. There is exactly one lever left to pull: speed. If you only get paid $50 for an hour of work, the only way to stay alive is to do that work in half the time. Push the car through faster, fewer hours per repair, move to the next one. Now run the number one more time because this is the moment the whole thing turns from a money story into a safety story. What is the single easiest thing to skip when you're being forced to rush? Not the visible stuff. The customer sees the paint. The customer sees the panel gaps. The customer will notice if the bumper's crooked. So those get done. What gets skipped is the invisible work. The work no customer can see and no customer knows to ask about. Like calibration. Your car, even a pretty ordinary one now, is covered in sensors. Radar behind the bumper for adaptive cruise and automatic braking. Cameras for lane keeping. Blind spot monitors tucked into the corners of that very bumper we just replaced. When you take that bumper off and put a new one on, especially a cheaper one that sits a couple of millimeters differently, those sensors are now aiming at the wrong point in the world. The manufacturer's book says, recalibrate them. That's a separate procedure. It takes time, it takes equipment, it takes a technician who isn't being timed with a stopwatch. So, picture the shop. $50 an hour, rushing to survive. A car that looks perfect sitting in the bay, bumper on, paint matched, ready to hand back. And a blind spot sensor behind that bumper that nobody recalibrated, now quietly pointed 3 degrees off, telling you the lane is clear when there's a truck in it. The customer drives away thrilled. Looks brand new. And the risk, the gap, went home with them, invisible, sitting behind the plastic. Who kept the dollar? The insurer. Who's carrying the risk? The driver who has no idea the sensor is lying to them. And here's the part people get wrong about the mechanic. They blame him. When something goes wrong, the customer's anger goes straight to the shop that touched the car. But go back to the strings. Imagine you're that shop owner. You know the right way. You want to do the right way. But you're renting your customers from the insurer, and if you keep fighting the software, keep demanding the $800 part, keep billing the calibration, keep insisting on the hours the job actually takes, the insurer has a simple, quiet response. They take you off the list. The river of customers stops overnight. And a body shop that suddenly loses 40, 50, 60% of its car flow doesn't get to make a principled stand for very long. It closes. The technician who wanted to do it right is now unemployed, and the shop 2 towns over that plays ball gets your car instead. That's the trap. The mechanic isn't the villain, and he isn't a hero. He's a man with strings on his wrists, choosing between doing the job wrong and not having a job. Most of the time, the mortgage wins. I'm not excusing it, I'm explaining it. Because if you blame only the hands holding the glue, you'll never look up and see who's holding the strings. Now, let me be honest about what I can't prove, because I'd rather you trust me than believe me. I cannot tell you the exact percentage of repairs where a critical safety step gets skipped. Nobody can, that data isn't collected. and the shops that cut corners aren't exactly publishing it. I'm not going to invent a scary statistic to win the argument. What I can do is show you what it looks like when the gap goes all the way to the end of the line, and for that I don't need a hypothetical. I have a courtroom. Texas. A young couple, Matthew and Marcia Sebachan, bought a used Honda Fit. They had no idea that before they owned it, that car had been in a hailstorm and repaired at a shop called John Eagle Collision Center. During that repair, the roof needed to be replaced. And Honda's manual, the book, the promise was extremely specific about how a roof gets attached on that car. It's supposed to be welded. Dozens of specific welds engineered so that in a crash the roof and the frame work together to keep the cabin from collapsing. The shop didn't weld it. They bonded the roof on with adhesive, with glue, and in the trial that followed, the shop's own body shop director testified about why shops make these choices, that they feel pressure from insurers over what will and won't get paid for. The glue was cheaper, the glue was faster, and on paper, the car looked fixed. Then, in 2013, the Sebachans crashed. A collision that, in a properly welded fit, they very likely would have walked away from. Instead, the roof structure gave way, the car folded, they were trapped inside, and a fire started. Both of them were catastrophically burned. In 2017, a jury awarded them roughly $42 million against the body shop. The shop was found liable, and the couple later brought a separate case against the insurer, State Farm, which was resolved out of court with no admission of wrongdoing. So let me be careful and fair here. No court ruled the insurer legally caused this, but everyone in the collision industry understood exactly what that case was really about. It was about the gap. It was about a repair decision made not by what the manual required, but by what was cheapest to authorize. The hands held the glue, but the strings ran somewhere else. I'm not showing you that to scare you, and I'm not telling you your car is a death trap. The overwhelming majority of repairs never come anywhere near that outcome. I'm showing it to you because it's the clearest proof that the gap is not an abstraction. It's real, it's physical, and once in a great while it's fatal. The math has a body count, even if it's a small one. So what do you actually do with this? Here's where I want to steer you away from the two loud, useless answers. The first loud answer is the conspiracy one. Insurance is a racket, they're all crooks, burn it down. That's wrong, and it'll cost you, you still need coverage, and the pool still protects you. The second loud answer is the naive one. Just trust the system, they're the professionals, sign where they point. That's how the gap gets transferred onto you without you ever noticing. Both of those are easy, both of those are lazy. The calm answer is in the middle, and it costs you nothing but a little attention. Know this, in almost every case, the choice of body shop is legally yours, not the insurer's. When they hand you the list and say, take it here, that list is a suggestion dressed up as an instruction. You can pick your own shop. You can pick one that isn't renting its customers from the company writing the check. When you get the estimate, read it, actually read it, and look for two words, the parts. If it says aftermarket or non-OEM on something structural, you're allowed to ask why, and you're allowed to ask for OEM. Ask out loud whether the safety systems were recalibrated, and ask for it in writing. You paid a premium for a promise measured against the manufacturer's book. You are allowed to hold them to the book. You're not going to win every one of those arguments. Sometimes the answer is a fair no, but the person who reads the estimate and asks the question is a very different customer than the one who signs where the pen points. One of them keeps the risk without knowing it. The other one at least gets to see the strings. That's the whole thing, really. Every repair is a quiet negotiation over one number, the gap between the fix you were promised and the fix they'll pay for. Every dollar of that gap is their profit and your risk. Learn to see that number, and you'll never look at an estimate the same way again. The mechanic holds the wrench. Just make sure you're the one holding the strings. If running the numbers before you sign anything is how you want to think about money, and about the people quietly making decisions with it on your behalf, then subscribe. That's the entire point of this channel. We do the math out loud so you never have to take anyone's word for it, including mine. I'll see you in the next one.